Hi, everybody. I'm John Carvalho, president of Stone Oak Capital and Divestopedia. I'm so excited for this discussion on mitigating risk in M&A transactions. We're going to be talking about representation and warranty insurance, deal structuring, due diligence, and risk around ESG issues. We have a lot to address today, but we will have time towards the end of the hour to take some questions from the audience. So if you do have questions, enter them into the Q&A. We have an all-star panel that's joining us today. I'm super grateful for them. I'll give a quick introduction. So legal experts from Seyfarth Shaw, Jenna Usenheimer and Brian O'Keefe. We have private equity professional from HKW, Luke Fennessy, and we have rep and warranty insurance expert from Dual Transactional Risk, Dan Simnowitz. Welcome, everyone.
Thanks for having us.
Thank you.
Jenna and Brian, you guys are acting as a tag team today. So if you guys can just give us a quick background and overview of your expertise and give the audience a little bit of context in terms of how you guys participate in this M&A industry.
Yeah, great. Thanks, John. Thanks for having us. We appreciate it. I'm Brian O'Keefe. I'm a partner at Seyfarth, Washington, D.C. office. Before at Seyfarth, I was at Kirkland & Ellis, had become very familiar with the reps and warranty product there from the buy side. And then after coming to Seyfarth a couple of years ago, along with Jenna, we had started a practice here where we are representing the insurers now as underwriting counsel on deals. It's a very growing and robust practice at this point. I represent many of the leading insurers in North America as their underwriting counsel, and just are very excited and happy to be here.
Awesome. Thanks, Brian. Jenna and Brian, I feel like we need a tag team name for you guys, like something. We'll figure that out as we go. Luke, can you give us a quick background on you and HKW?
Sure, Luke Fennessy, and thanks for having us today. But Luke Fennessy, I'm the lead transaction partner at HKW. HKW is a middle market private equity fund, and we focus on business services and the health and wellness sectors.
Awesome. Thank you, Luke. Dan, welcome. You're kind of a late inning fill-in for one of your colleagues, but thanks for joining us. Can you give us a background on your firm?
Sure. Dan Simnowitz. I'm one of the principals at Dual Transactional Risk. We underwrite reps and warranties insurance for middle market, really all size M&A transactions, and we work with folks like Brian and Jenna in underwriting the deals.
Awesome, thanks, guys. Hey, we have a lot to get to, so I really want to get started on just kind of the state of the M&A environment right now with regards to risk and uncertainty. So, Jenna, maybe I'll start with you here. Can you give us a perspective on the M&A market right now and what you're seeing with your clients with relations to their appetite for risk and uncertainty that they're seeing in the market?
Yeah, I mean, I would say, and I think everyone on the panel would agree with me, that business is booming. I think that the M&A activity is like skyrocketing. I don't know if it's a reaction to the slowdown last year during COVID or just market conditions are right, but everybody seems to be very actively engaged in M&A activity. And it does seem to us like the risk is not slowing people down. The parties seem interested in taking on risk. Dan can speak to the underwriter perspective, but the underwriters continue to be interested in taking on risk. So it seems to us that really nothing is slowing down. It's quite the opposite.
Brian, you want to add to that, or what are you seeing for? Obviously you and Jenna work closely together, but what is spurring that this robust environment right now?
Yeah, I don't want to mess with perfection, but I agree with everything Jenna said. I think that's really hits the nail on the head. And yeah, I think there's a wide variety of hypotheses out there. Just pent up demand. The recession that we've had has not been as deep or bad as people kind of thought it would be. Deal makers, such as Luke and others, have gotten their head around how to do due diligence, even in the middle of the pandemic, and have figured it out. So M&A stayed strong. So I think it's probably a combination of all those factors. But yes, I think that everybody who's involved in this niche industry is seeing a very active time right now.
Luke, how is HKW kind of reacting to this kind of risk and uncertainty in the market right now? Are you guys very active, and is there lots of deals going on in your firm?
Yeah, I would say volume is as high as it's been in several years, and I think one of the things that's driving that, again, there are a lot of different theories on it. And you always hear this, but this year I think especially there's a lot of concern about potential for capital gains rates to change next year. And usually you hear that around, presidential cycles, before the election outcomes are known, et cetera. That may drive some activity. But this year I think there is a lot of focus on it. We're hearing a lot of people trying to get out ahead and take advantage if capital gains rates do move. That has a pretty material outcome on how much people make. That's a big one. There are a lot of other risks in the market. I think, rates are still fairly low, but inflation is, definitely around the corner. I think wage inflation certainly higher with, potential for federal minimum wage increases. If you have a business that's maybe doing manufacturing, it has a lower wage environment or a lot of workers. I mean, there's that potential. So there's a lot of potential things that could change, and right now is a pretty good time to sell. If there's last year a lot of people kind of not a lot of activity, and with the uncertainty of what's going to happen. But now that there's more clarity, I just think a lot of these factors combined make it a pretty good time to sell if you have a company that's ready to go to market.
Yeah, it sounds like maybe that pent up demand has been, just increasing, and then once that uncertainty eased a bit, then the deal makers got at it. Dan, are you seeing the same thing in your practice with regards to deal volume and deal appetite? I'm sure you come across a lot of transactions, and are you seeing deal volumes increase?
Deal volumes are way up in 2020, in 2021. Actually, if you go back to 2019, most rep and warranty insurers saw more submissions than they had in any, since this market really picked back up in 2014. And then we took a pause with COVID, but then things really started to pick up, I'd say, fourth quarter of last year. And I think that corresponds with when a lot of businesses had been, a lot of PE firms specifically had sort of been waiting out, see how businesses perform during the pandemic, how they were affected. And once everybody figured out how to value a business through the pandemic, how the business withstood the pandemic, you saw everyone jump back into the market at the same time. So we had a record fourth quarter. I've never seen a fourth quarter like that as a rep and warranty insurer, and I'm sure Brian and Jenna would agree with that. They were involved in all those deals. And then it's really continued at a very steady pace in 2021. We've seen, I think, last count, close to 2,000 submissions in about almost 6 months, which would put us on pace for a record year in terms of the amount of submissions of deals. So deal volume is extremely high, and the demand for rep and warranty insurance is there.
Yeah, that's amazing, given kind of all of the the unprecedented events that have happened over the last year, and that we've come out of it in this kind of very robust deal making environment. I want to switch gears here a bit and just talk about due diligence. So Luke, how have you kind of overcome some of the hurdles around due diligence in a virtual world? I guess before the broadcast, we were talking that the world is opening up again and kind of getting back to normal. But maybe talk about that, again, world of virtual, virtual interaction versus being able to travel out to potential targets, and how you kind of navigated that aspect of doing due diligence.
Yeah, it's a great question. There's different kinds of firms, private equity firms. We're very much that investor focus where you really, you're trying to find a great team to run the business. And I think for groups like us, meeting a team in person, seeing how the team interacts with each other, those kinds of things are really important as you assess a team. And I think that, obviously people everyone became experts on Zoom calls and things. And that's what you had to do. I think from a being able to assess a team, I like to sit there in a meeting and then watch and see how the interactions take place. And, you know, is the president talking the whole time, or does, you know, is there a deferral to the different vice presidents, and just how the whole interaction works? And you lose a lot of that with Zoom meetings, you know, because usually whoever's talking, they have the floor, and you miss a lot of that more nonverbal stuff that's so helpful when you assess a team. But we had to deal with it. I think that the processes became more efficient. You know, usually in a process, you have an initial indication of interest phase, and then you might get, you know, 6 to 8 kind of groups invited in to meet with the management team in person. And then you kind of narrow it down from there. Maybe they select 1 or 2. It is more efficient now, right? Instead of those 8 management meetings, you do Zoom meetings. And then, you know, from there, it's maybe 1 or 2 in-person meetings where they really pick the group. So, and again, groups like us, it's very much, there's an intangible piece to what we do. And if you're not meeting people in those management presentations, you lose some of that advantage. So for us, it's, you know, we tried to be as Zoom friendly as we can and get through those next meetings, but it was tricky. I think from an efficiency standpoint, though, in the actual due diligence process, once we got companies signed up, I do think it was helpful, you know, from a due diligence provider standpoint. So for a QV accounting firm, some of the other stuff, not having to go there and physically be there all day and being able to do more things remotely, you know, frankly, just made them a little bit more efficient too. So there's pros and cons, certainly. As a buyer, you like the in-person interaction. As a service provider, it does, I think, help make things more efficient. So, you know, a little mix of both, I would say.
Yeah. Do you think you continue with those due diligence practices go forward, or do you think you go back to kind of the pre-COVID way of doing things?
Well, I think so. From a due diligence standpoint, I do think that will probably continue with the service providers, that they're able to, you know, frankly, get more, you know, leverage their time better. And I think that's always a good thing. I think the investment bankers, as they put companies to market, will probably keep the initial round of Zoom meetings and narrow it down. It just makes things more efficient for the teams. I mean, if a team's doing an eight management presentation kind of assignment, that just wears on you, wears on your family. Whereas Zoom, you can schedule them a little bit more efficiently, and then really narrow down to 2 or 3 groups to do an in-person meeting. So unfortunately, I think that's probably, you know, here to stay. But
Yeah,
you know, I guess we'll see. Everything, you know, it's a pendulum, and we swung pretty far one way, and it'll probably swing back a little to a more normal environment.
Yeah, that's great insight on your guys' due diligence process during this last year. Dan, how have some of the challenges with, you know, lack of due diligence or this virtual due diligence been incorporated into kind of the reps and warranty insurance policies?
So it's a good question. So I think the first thing to point out is, you know, typically, to the extent that there's, you know, no diligence performed on a particular rep or warranty, if it has a potential to be a material exposure, that's not something we're going to cover. So I think that's kind of the rules of the road to put that out there to begin with. But from you know, over the last year or so, everyone's been working virtually. I haven't seen any drop off in due diligence based on folks not being able to be on site. I think there's that intangible aspect from a buyer's perspective that Luke mentioned, you know, getting a feel for the management team and with those in-person meetings. And I think maybe that is lost for buyers. And I think some of that does shine through for us when we have calls with the buyers, our diligence calls. We can see who really has a good feel for the management team and who doesn't. But really, from an underwriting perspective for us, we've seen no drop off based on the pandemic. The one thing I'll mention is at the very sort of let's call it mid last year, the deals that were getting done didn't require on-site visits. So software companies, businesses that were, you know, adapted, target companies that had already adapted to a virtual world. As folks became a little more comfortable traveling, sort of late third, fourth quarter, and then into this year, we've seen a lot more businesses that have hard, you know, sort of tangible physical assets, manufacturers, you know, distributors, warehouses, things of that nature. where, you know, on-site visits are more important, and we've now started to see that. So you now started to, you know, we hear on calls that there are more meetings in-person meetings with management teams, maybe less than there had been. But for us as a process, we underwrite to the diligence you can perform. And I think the buyers have done a great job in sort of adapting, and the rep and warranty market has tried to have been as flexible as possible.
Yeah, that's a super interesting point that, you know, there are some businesses that you don't really need, you know, on-site visits in this digital world. So those were, you know, potentially more of those deals were getting done over that period where, you know, you didn't have to actually go physically and visit a location. That's a really interesting insight there. Jenna and Brian, Brian, maybe I'll start with you on this one. How have you seen, you know, this kind of due diligence over the last year and some of these new practices with virtual, online, maybe due diligence being more prevalent? How have you seen that translated specifically into purchase and sale agreements? Are there any new terms or any considerations in that you're seeing?
Yeah, I agree with the other panelists first, you know, with sort of the broad, you know, the broad points. I don't think that, you know, I don't necessarily think that there's been any, you know, exact new provisions in purchase agreements around this. I think it's sort of subject to the same scrutiny that you would expect to see. As Dan said, you know, for software companies and other service organizations that just have leased office space and the space really isn't that spectacular, you know, having on-site visits and that sort of thing, you know, usually aren't that important and, you know, aren't going to usually be a big deal. You know, there are some other businesses though where, you know, the equipment, the sort of nuts and bolts of the business actually are important. And, you know, the reps, the very customary reps in your agreements about, you know, sufficiency of assets and that everything's in good order and repair, you know, those sort of reps, you know, having some sort of on-site diligence usually is important to make sure that, you know, that later on that, you know, you're sort of not buying a lemon, and that could put the insurer in a particular bind. So, so I agree with what everybody said. I think that, you know, the purchase agreements, I think have largely, you know, sort of followed that and are tracking that. But I've actually been very impressed as well with the buyers and the buy-side law firms. I think that it, you know, took a little bit of getting used to, but I think everybody, you know, has sort of figured out how to do this and how to put together reports and how to adapt to this virtually and how to do the diligence. And obviously the market has responded by the number of policies that are being underwritten right now. Believe me, if we didn't think that the diligence was there, we thought there was huge gaps, the insurers would not be underwriting the number of policies that they are right now. And I think that their appetite for this just reflects that they are satisfied with what the buyers are going out there. And that's a lot of kudos to folks like Luke and other buyers out there in the market.
Mm-hmm. Yeah, no, deal makers are resilient, aren't they?
Yes, indeed.
I'll tag in your partner, Jenna, your comments on just, you know, anything that you've seen that's translated, you know, this risk and uncertainty in the market that's translated into purchase agreements.
Yeah, I mean, I would echo the comments that everyone else made here. I mean, the one addition that we see in the purchase agreements, which I think everybody would expect to see, are we often see now COVID-specific reps and COVID making their way into the other standard reps that we would see. That's just a function of the environment, you know, not so much the virtual diligence space. But I think echoing what Luke said in particular, more and more now on the, like when we have bring down calls, we are getting much more robust discussions and descriptions of the ongoing interaction between the buyer and management. It seems like there's much more collaboration. It seems like people are actually getting together, whether, you know, maybe some of it's over Zoom, but it really does seem like there's much more collaboration than at least that we were seeing last year. So I think everything is sort of moving in the right direction.
What would that COVID specific rep look like? What would that include? What would that cover?
Well, they come in all shapes and sizes, really,
Yeah.
as I think everyone on the call can attest to. But we often see reps with respect to PPP loans and CARES Act compliance. We see a lot of reps with respect to employees compliance with all like safer at home, stay in, you know, shelter in place orders, regulations, protection of employees. you know, COVID will sneak its way into other, like, general compliance with laws, and then they'll say, like, including COVID. So it sort of creeps up in different ways. And I think that that's also very, you know, I think echoing some of Brian's comments, it's consistent with the environment that you're in. So if it's, you know, like a company that really has not been impacted at all by COVID, maybe you don't see any changes to the purchase agreement. But then companies, you know, like Dan was talking about, you know, manufacturing, then maybe they're more likely to see it. If it's an environment where employees are together, then it's more of an issue for the buyers.
Great, thanks. So talking specifically about M&A reps and warranty insurance, Dan, you know, for some of our, you know, audience participants that maybe aren't familiar with, you know, rep and warranty insurance, and what would the acronym be? Is it RWI? Is that a fair acronym for that?
Absolutely, yes.
Yeah. Okay. So let's call it RWI. For RWI, can you just provide an overview of that, and then also, you know, give us maybe an idea of how many deals it's actually used on? It's you know, it sounds like the volume and percentage of use is definitely increasing, and then other things such as like you know, typical deal size, premium as a percentage of coverage limits. Maybe you can give us some specifics around RWI.
Sure, John. So RWI reps and warranties insurance comes in two flavors. You've got insurance that the seller buys, and this is the less frequently used. In fact, we rarely see it anymore. Insurance that the seller buys to backstop its escrow. So if it puts an escrow out on to backstop the reps and warranties, they can buy insurance. So if they pay out on the escrow, the insurance will reimburse them for that. And then they have the much more frequent buy-side rep and warranty insurance. That's when the buyer buys the insurance to protect against breaches of reps and warranties. So what we cover under these policies, and it's really, you can look at it under the buy side as what I'd like to say is an escrow replacement. It doesn't fully replace your typical escrow that you put in, that you would include in most deals for breaches of reps and warranties in the private company M&A world. But what it does do is significantly reduces the escrow that a seller needs to put up. So it's a deal enhancer, it's a deal facilitator. It takes away a lot of the negotiations around caps and baskets and how much escrow you want to put in and what's subject to the escrow. It sort of takes away a lot of those terms and allows the parties to really focus on negotiating the reps and getting their deals done. So we insure against, our coverage is for the buyer for the most part, and it's for breaches of any reps and warranties in the agreement. So to the extent that there are unknown matters that later arise to a breach, that's what we provide coverage for. So we don't provide coverage for known matters, so known exposure. So if you have, you know, a bunch of lawsuits out there, we're not going to cover those lawsuits. Those are more of a sort of for a different type of transactional insurance product. But we're going to cover unknown breaches of reps and warranties. In terms of our, you know, the uptake of this product, well, it's been tremendous. So I think it's been around, reps and warranties insurance has been around since, let's call it in its infancy, 1999, 2000. There wasn't, the process of underwriting a deal was really clunky. Insurers would need, you know, months and actually have to go along with the buyer as they were doing the diligence. The product kind of got streamlined in five or 6 years ago. The product really sort of got streamlined and it picked up a lot of steam with financial and private equity buyers. And the underwriting process got a lot more efficient. And what it has turned into now is a sort of really robust market where, like I said, we're seeing, you know, on pace to see 4,000 submissions a year, probably more than that, binding 200-300 policies per year, probably even more than that this year. So the market is robust. I'd say, you know, you hear a lot of statistics about, you know, and they're all sort of anecdotal, but 75% of sort of private company deals with financial sponsor buyers use rep and warranty insurance. There's been a significant uptake from strategic buyers. When I first started doing this 4 or 5 years ago, very few strategics were willing to look at rep and warranty. They wanted the traditional escrow, and if they were buying a private company, now strategics have kind of been forced into that process, dragged into that process a bit by the sellers, as the sellers are now demanding rep and warranty insurance on almost every transaction. So that's kind of how we got to where we are today. But the market is robust, as Brian and Jenna can tell you. We are, you know, bursting at the seams with submissions and deals.
No, that's an awesome overview, Dan. Thank you for that. Just a couple of follow-on questions. So typical deal size, what would be kind of the smallest deal size that you would see on a having RWI?
Yeah, it's funny that the market, it used to be 3 or 4 years ago that, many insurers wouldn't entertain a deal less than 100 million in enterprise value. Then it was 50 million in enterprise value. Now I think a lot of insurers will look at deals, as low as $10 million in enterprise value. So I think that some of the challenges that you see in some of the smaller deals is maybe the diligence isn't as robust. But we're more than willing to look at sort of the smaller to middle market deals. I'd say, the average deal size is probably somewhere in the $200 to $300 million range. And we've been part of towers that have insured, or layers of insurance that have insured deals with enterprise value up to about $27 billion. So there have been extremely large transactions and really, really small transactions. You can really fit this product to any type, any sort of industry sector, any size of deal.
Mm-hmm. And then premiums as a percentage of coverage limits, what do you, and it probably depends, and maybe that's a loaded question.
It depends. Yeah, let's just say somewhere in the neighborhood of, depends on the size of the deal, average premium somewhere between 3 and 4% per $1 million of limits. And typically the typical purchasing pattern is purchasing 10% in limits of liabilities of the size of the deal. So if you have a $100 million deal, you buy a $10 million limit of liability.
Awesome. Thanks, Dan, for that. Janet and Brian, what are you guys seeing? Have there been any changes over the last year on rep and warranty insurance policies? Anything that's kind of, due to what's been happening in the world that you've seen? I'll start with Jenna.
Well, I would say, and Brian and I are probably going to say the same thing. It happens to us a lot. I'd say one of the biggest changes that we've seen is the use of the rep and warranty insurance product in like new and emerging spaces. So not just a traditional M&A, but in secondary deals, and different markets are coming up with lots of different products to sort of help everybody get the deal done. I would say that is one of the maybe the most surprising thing that we've seen over the last year is just like the growth and explosion of the product in sort of non-traditional spaces. I'd say that's Brian, what do you think? That's the biggest thing.
Yeah, I agree with that. And then I think too, I'll sort of tag on to something you said before, Jenna, about COVID. So, it is very common in purchase agreements today to see very specific reps about COVID. Many insurance markets will read out those specific reps, so they're not going to provide coverage on the exact wording you may have about COVID, but they will still provide some level of COVID coverage. I think there are still some markets that have very strict exclusions around COVID. I think that was the way that it sort of naturally happened right after the pandemic got started. But I think that many markets now will underwrite to it. And if you have diligence that you really were not impacted by COVID that much, they will have a much lighter exclusion around COVID. And I think that's consistent as well with something I've been saying for the last year and a half, which is that COVID really impacted industries unevenly. You have a software company that everyone pretty much was working on their computers anyway, and they don't need to be in the office, and perhaps maybe their product is something that is actually more popular now because of the pandemic. It's kind of hard to say that there should be some giant exclusion or some giant negative detriment, because perhaps the pandemic really didn't impact that. In contrast to like a company that was, a food manufacturer or something that, where there was sort of, perhaps a bigger impact to COVID. So I think that that's been an evolution of having a very sort of flat exclusion on it to something where the markets are really, I think, trying to underwrite to it in most circumstances.
Mm-hmm. Luke, you've been patient here. Appreciate that. Do you use rep and warranty insurance on all of your transactions? And I mean, does it change the way that you think about kind of risk and diligence and deal pricing? Love to get your thoughts from the guy that's actually buying these targets.
So what's rep and warranty insurance again? So to answer your first question, yes, we use it, and we've used it on every one of our platform company acquisitions going back probably 5 or 6 years. I feel like we were on the earlier end of, of the groups, and at least in our segment of the market who used it. I think it used to be an advantage. It's not necessarily worse, since it's pretty well common practice to use. I think Dan had mentioned it though. There is a size at which it really doesn't make as much sense. And so for our add-on acquisition, so the companies that we buy a platform company with a management team and a sort of base business. And then if we buy a smaller company and, roll it into there, that's what we call add-ons. We don't always use it, in part because the size of the deal might be too small. It might be, $5 million deal or something, and where it just doesn't make a lot of sense. But whenever we can use it, we absolutely do use it. And then what was your next question? Sorry.
Just around, there's this relationship between risk and value and price. So, now that you have this policy that kind of reduces some of the risk around a deal, does that impact the price that you're willing to pay, a valuation that you're willing to, kind of consider for an acquisition?
Yeah, I mean, there's a lot of ways to answer that. Maybe I think it doesn't change what we do in terms of due diligence. So having the product is nice. Again, I think it was Dan maybe that said what it really helped is reduce the big escrow. So how much cash that a seller ultimately gets to take home at closing. Going back 10 years ago when it didn't exist, as a seller, you might have to leave, like you said, 10% of the purchase price sitting around for 12 months. And, we've had a couple of situations where, probably sold it to the wrong buyer and they used that as a way to go carve back some purchase price, in really in bad faith, I think. So not having that big pot of cash sitting out there for somebody to try to go after, I think is really, really helped. And that's, to me, it's the main reason, one of the main reasons to do it. Not as much because we don't want to do as much due diligence. I think our processes have, over time, we've increased the level of due diligence, not decreased it. And then the rep and warranty piece is there as a nice backstop, but we don't rely on that really as a way to avoid doing due diligence. That's a bad, formula. And then in terms of deal pricing relative to it, the pricing, it's gotten so expensive with everything, and you can't afford, you're already getting this asset that's priced to like the perfection, and you really can't afford to have other things show up that would mess it up. So it's really helpful, I guess, from that regard. But then a lot of the things that you might find, it's excluded anyway. Maybe you have a sales tax nexus issue that they're not going to touch, or there's an environmental known thing or litigation. And like one of the panelists said, there is insurance to deal with those two, and usually we try to bring other forms of insurance to deal with what would traditionally be an exclusion under that policy.
Yeah, that's a great segue into the next topic I want to touch on, which is deal pricing and deal structure. So Brian, I'll start with you here. Have you seen like a shift in deal structure over the last 12 months with the current environment? Maybe the use of more seller financing or earnouts. What are you seeing in the market around deal structure and pricing?
Yeah, I think that's true. I think we have seen some of that, and I think immediately after COVID, it was just a lot of uncertainty. But I still think it's such a competitive market right now, and I still think I still think it's a fairly seller-friendly market, and a lot of businesses really haven't been that impacted by this at the end of the day. So I think it's it's so interesting. There's so many things that have changed from February 2020 to where we stand today. But after an initial dip, I think that this has really stabilized and really sort of put us back into the same place where we've been, if not even a busier place. I agree with Dan completely of what the end of the year was and what it's actually been into 2021. I think there was a big question as to whether or not things were going to sort of slow down into 2021, and that certainly has not happened. I think we've just been busier than ever, and I think it's leading to the same sort of market conditions that we've seen for the last several years.
Mm-hmm. Janet, can you add to that?
Yeah, I mean, I agree. I largely agree with what Brian said. I mean, I would say that in the deals that I've seen, I've not seen increased use of seller earnouts. I mean, I think that the market on the whole, and Luke can weigh in on this also, is buyers are getting more comfortable with the COVID risks. You know, as Brian said, where a lot has changed since Q1 last year. I think that it's not as terrifying for everyone. I think it's not as scary. I think that businesses are, if a business didn't perform well in COVID and it's still being acquired, you know, they account for that in the purchase price. It's about like future synergies. I think buyers are willing to believe and feel comfortable that things are course correcting. I mean, certainly in certain states in America, life feels like it's getting back to normal. And I think that we're seeing that in the acquisition activity as well.
Mm-hmm. Luke, I mean, you're in the trenches every day. Were you using earnouts to get deals, or did you just put deals on the back burner over the last year until there was more kind of visibility on the targets, and then you went back to normal deal making structures and mechanics that you used?
We completed one platform company last year. Definitely was slower than our normal pace. We normally try to do 2 or 3. It wasn't from a lack of effort or trying. I think you understand as a seller, you're not going to sell your asset, especially if it's a really good asset in a down market or an uncertain market. It means you're not going to get as much for it. And so just like you go back the last couple of recessions, 2010, 11, go back to the dot-com era, coming out of that recession, usually, the year or two after a recession takes place, it's a really good time to put money to work. And it's a frothy time potentially too. So if you have a nice asset and you're a seller, you just don't sell last year. So there wasn't as much quality in the market. And I think that probably factored into why things weren't getting done. Probably the biggest thing from a buyer's perspective, looking, ahead and over the last year, is the adjustments related to COVID. And we just closed on a deal probably a month or 2 ago. They had a large adjustment for COVID. And interesting, they made the adjustment. We looked at it, kind of made sense. I mean, everyone knew that things slowed down, but a very well reputable QOV firm that we use really pushed back on the adjustment once they got into it, and where we were arguing over it more so than with the sellers. And the rationale was, look, yes, you shut down the facility, and yes, people took off a couple weeks, and yes, that should have been an adjustment. But at the end of the year, a lot of those sales that were put on hold came back. And so are you going to normalize those? And, you didn't travel as much last year. So you're going to normalize that the other way. So really trying to figure out what the right earnings normalization adjustment should be that derives a lot of the purchase price base that people end up valuing their companies off of. That's probably the biggest thing that we've had to really pick through and have opinions on what's reasonable, what's not. As it relates to valuation. And then, look, if there's a big disconnect on the bid ask, then that's where earnouts always come in. But it is frothy, and much of it's really dependent on the type of owner of it. So if it's if it's somebody that's really, we tend to look at founder-owned businesses where the founder or some component of it's going to remain with the business. And so they tend to retain a lot more of the equity. And so in a way, they're a kind of a buyer too, right? And so there's those situations. And then there's situations where maybe the team doesn't own any equity and the owner is really trying to maximize. So in those situations, cash is always king. In situations where the owners are going to stay on, that's more conducive to an earnout. Maybe we pay an earnout on how our investment does, or based on some future earnings or revenue stream. So it's really, I'd say it's situation dependent, but it's always like that. I don't think the COVID situation's really changed that a whole lot.
Mm-hmm. Is that frothiness right now, is that due to lots of capital chasing great deals, or is that just kind of overall every kind of company that's going to market is seeing an uptick in valuation multiples?
I think it's a little both. I mean, if you look at what drives valuations, I mean, interest rates for leverage type of buyers, traditional private equity funds will put leverage on a company. And when rates are lower, that means you can typically put a little bit more debt on them. So having the right interest rate environment is important. I think too, just that there's some pin-up demand. So, if people didn't do deals last year, they're under a little more pressure to put money to work this year. So that factors into it. I think the tax situation that we talked about, and that's more from a seller's perspective. So if you have a really good quality asset, and you sell it this year, maybe you don't get as much, but if you're not getting an extra 20% tax on your capital gains or whatever the number turns out to be, versus if you wait a year, maybe you get a little bit more, but your after tax is less, you're better off going now. So there's that situation, and where that comes out, who knows, but it's a risk. And so that a lot of these things are just, and then again, if you're expecting a sale last year and it got put on hold because of COVID, and or you weren't sure what COVID would do to your business, and now there's a lot more certainty around it, that's putting good assets in the market. And ultimately, that's as a buyer, you're looking for those kinds of situations, and you don't always get a pick when you want to put money to work. A lot of it's based on what the market's telling you. And right now it's frothy, so we're busy.
Yeah, for sure. Dan, does the pricing and structure of a transaction, does that have any impact on the rep and warranty insurance and the policies that you're putting out?
Yeah, I think the structure of the transaction, so you can look at a couple things, whether it's an asset deal or a stock deal. There are, asset deals because you can you're picking and choosing the assets that you're buying. The reps might be a little bit lighter, they might be different, so you're covering less. Instead of covering the entire enterprise, the entire organization, you're only looking at certain assets that are being purchased, and the reps go to those assets. So there are certain situations where if you look at an asset deal, it might be priced a little bit differently. So I think the way we always look at it is, it's not really the structure. For us, it's what are the reps that are actually being made by the seller about the business. And that kind of determines, if the reps are fulsome, then, the pricing could, and the reps are fulsome and there's risk on the business, the price could be a little bit higher. If the reps are a little lighter, even for a risky business, we only cover breaches of the reps. So if it's not a breach of the rep, we don't cover it. So I think our first look at everything is, what do the reps say? I think structure is a part of that. I think when there are certain types of deals that if they're structured in as an asset deal or more limited reps, that we will that it could affect the pricing, maybe a little downward.
Mm-hmm. No, that's interesting. So for our last topic, I mean, we only have about 10 minutes to talk about our last topic, and that probably is not going to be enough time to do it justice. But I'd really like to touch on this concept, a very important concept of the environmental, social, and governance issues that come up in a deal, and that are very relevant in today's environment. So, Luke, how are you assessing ESG in your target companies in measuring risk of potential non-compliance around any target or investment that you make?
Yeah, no, it's an interesting topic. Definitely a lot more attention has been placed on it. It's a topic we've always focused on. I think most groups have. They just haven't been as maybe they haven't documented what they've done and such. And I think that's really where the attention's turned. So our process is one of a scorecard. So we go in and we do an initial assessment when we're looking at a company, and we'll put a scorecard together on the 3 different variables. And within them, there's a number of things you look at, and then we'll give a company a score. And usually it's not like a walk away situation where if they don't have a certain policy, we'll walk away. And I think that's not necessarily the intention of what ESG is supposed to represent. It's trying to take something and making it better. And so our initial assessment of now, if there's some things they're doing that are clearly wrong, we would walk, most likely, because we wouldn't want to get involved with a situation like that. So, but for the most part, you come in, you do an assessment. We use a scorecard. We assign a grade, a number score to it in the 3 different areas. And then once we own the asset and it's in the portfolio, then we use a grading system. We'll improve certain policies maybe that weren't in place at closing. and we'll just try to improve the overall score of that, that risk. I'm using the score term, but we're trying to improve the policies in the company that gives it a better score. And that's how we do it. We track it through a scorecard. I think that, again, it's becoming more focused, but, underlying premise, if you're doing these things, there's less risk that something comes up, and ultimately it leads to value within the business. If you're avoiding, disaster situations that may come into play, that there's governance problems, or whatever, the right policy isn't in place around hiring or an HR practice, that could come and bite you and hurt the value of the business ultimately. So there's the right thing to do piece, and then it also is sort of attracted to the eventual value that you get out of it when you sell. So that's how we do it.
Yeah, and I mean, there's so much gray to this, right? In terms of the measurement, even like different geographies may have different kind of assessments of what's appropriate. So that's interesting that you have that scorecard, and you sound like you've been your firm has been very proactive in that, and an early adopter of it.
Yeah, I feel like we are. We actually have an officer that focuses on that and makes sure that all the chairmen of the companies have it in place. And to your point, there's levels, right? There's differing degrees of how much you track and what you do. And I think we try to strike the right balance where we're not putting too much pressure on companies to be, at the highest level of compliance. But we review them every board meetings. We look at the scorecards, and we're trying to be good stewards of businesses and improving in all three of these areas, during our ownership period. And I think that's what our investor group expects from us. And again, it's a nice thing to do, but I think it also eventually leads to better value when you go to sell, because you're not having, some of the skeletons in the closet from the next group that could find stuff like that. So I think it works hand in hand.
Mm-hmm. Dan, how is ESG being considered in rep and warranty insurance specifically? And what are some of the challenges? Again, I mean, there's lots of gray to all of this. So what are some of the challenges that you're seeing, and some of the ways that you're overcoming those challenges?
ESG is a really interesting point. I'd say in the last 2-3 years, we started seeing mostly private equity buyers bringing in outside ESG consultants to sort of take an overview and perform almost like a diligence report on the company's ESG, environmental, social, and governance practices. And what I found there is that companies that really pay attention to ESG are better risks for us, right? Not only with respect, so it's almost like an overall risk management framework for the company. So how do they sort of prevent? Yeah, how do they look at things like, how the business is contributing, what impact the business has on our environmental, so waste and pollution, social issues, and that leads into kind of how the work health and safety for their workers and how folks are treated in the workplace. And then from a governance perspective, how is the company really being run? What's their sort of posture towards lobbying and dealing with other governmental officials? So a company that I found the companies that do really well in ESG assessments are much better risks for us. So they don't necessarily impact our coverage, but I don't always know before I get involved in actually underwriting the deal and then we review the buyer's diligence. I don't always know that the company has a great sort of is going to do well with respect to ESG, but when I do see it, I feel much more comfortable with the company and underwriting and taking certain risks, more so than I would have if the company was sort of failing in every way with respect to ESG. So it's something that's relatively new in the process, and it doesn't always speak to specific issues, but more so the overall feel that I get for the company's ability to manage risk and then also to mitigate issues that might come up in the future.
Yeah, I like that perspective where it's kind of like a risk management assessment versus looking at for any specific issue within one of those three areas. Jenna, what areas do you think need to be considered around this ESG, and how can these areas kind of be mitigated within legal agreements?
Well, I agree with everything that's been said. And when we get ESG reports, typically just like Luke said, it's on a grade. We never see a company that has A+ across the board. We never see total disasters across the board. And usually what's analyzed does fit pretty well into the reps that are in the agreement and the other diligence that's done, right? So for example, with respect to environmental, usually, it touches on other environmental like diligence that we would see. It touches on OSHA, it touches on these other areas that directly go to the reps that are being made in the agreement. I mean, I would say that the social piece of it usually, speaks to employment-like practices, but where I find it the most helpful is in companies that are heavily involved in international trade, and it speaks to, sometimes there's risk for human trafficking and their trading partners, and that sometimes is a window into what we might not get otherwise from the diligence. So I find that that's a very helpful, just sort of like insight into what the company is doing and how it's being run with respect to those kind of issues.
Brian, your thoughts?
Yeah, no, I agree with everything that the co-panelists have said, and I really echo what Dan said too. I think that at the end of the day, when we go through this exercise on the underwriting side, there are sometimes we get off the phone and we say, well, that company's sort of a disaster and it has a lot of issues and there's going to be a lot of exclusions. And, I've never done a study on it, but I think that there's probably some correlation to companies that fit that list that also, score poorly on these ESG marks versus, the companies where we get off the phone and say that company really has its house in order. There's going to be a minimal number of exclusions or maybe zero exclusions on this policy beyond the standard ones. And, we're going to be able to get this deal done pretty quickly. And I think a lot of those companies are better run and are paying, more attention to these sort of issues. I think that there is, I don't have a study, but I think there is at least some correlation between those two areas. Yeah.
And I'll just add one more thing. I feel better about a buyer that takes ESG issues seriously. So if they're commissioning a report, even if the company is maybe not focusing on it, I feel much better. At the end of the day, we're sort of taking the ride with the buyer, right? We're looking at the buyer's diligence. We're underwriting the buyer and its process and its procedures as much as we are the target company about which the reps are being made. So if the buyer's focused on ESG, then I think that speaks well to the way that they're doing their diligence, and then how they're going to sort of view risk, and probably similar to the way that we will.
Great point. Yeah, I mean, a very relevant topic and probably deserves a little bit more depth and exploration. So, I mean, for our audience, we'll probably try to find another webinar that'll touch specifically on ESG. But so those are all the topics I wanted to cover. We'll get into some questions from our audience here. And one question that's come through that I think is maybe appropriate for Luke. So how can someone be kind of cautious in this very robust deal environment? How can you be proactive with trying to get involved in deals, but also be cautious with the frothiness and the high valuations? How do you balance those two?
Yeah, no, it's a great question. And look, it's frothy now. If you would have asked me in 2016, I would have said it was frothy. As a buyer, it's always frothy. So, it's perspective, I guess. But, the thing that I feel like more so now than ever, and it's going to continue to be more so now than ever, is you really have to have a succinct plan of what the type of deal that works for you. And we call it our sweet spot. So we know if we see certain characteristics of a company that we like, if we don't see that in a business, it probably means we're not going to be, successful in pursuing the acquisition ultimately to a closing. So, what do I mean by that? Like, we know there's certain tenets of a deal that you have to see for that to work, because ultimately it's your time and resources, right? That's your most valuable asset. And if we're just chasing everything, then you're just not going to be successful. So really, I mean, the Good to Great book everyone references, I'll reference it. I mean, that hedgehog concept, you have to know what you do really well. And how do you know that? I mean, that's experience, that's time. But once you define that and you really understand this is what our sweet spot is, and you look for those characteristics in the deal, and once you find them, then you can really lean into something, and that's where you know that you should spend your time. And and I think the industry specialized, right? As people get more specialized, they really know what makes characteristics of a deal work for them, and that's what I would say. It's you really have to understand that about your firm and what makes successful deals, and then conversely, what doesn't. If things haven't worked out in the past, maybe you shouldn't do them anymore.
Mm-hmm. Any other panelists want to weigh in on that specific question? Awesome. We'll move on to the next one here then. Dan, this is probably relevant for you, but how many claims have there been on rep and warranty insurance policies, and what type of claims do you see that are being claimed, I guess, under the policies?
Sure. So claims, an interesting topic, because unlike in a lot of other lines of business when it comes to insurance, there isn't a lot of publicly available data on claims. Most disputes with respect to rep and warranty insurance are settled either privately or through mediation. So it's not really reported widely like you might see for, say, like a securities class action that would be covered under a D&O policy. We all know the statistics, we all know the settlement, so we can estimate the losses. In our line of business, that anecdotally, some insurance companies, some brokers have put out estimates of the amount of notices, so claim notices that they receive on each per policy. So I think it's somewhere in the neighborhood of 20 to 25% of the policies that we get, or that any insurer would get, has a claim notice. Doesn't mean that there's an actual claim that's going to be paid, but that there's a notice of a breach, right? And I think it's probably a smaller fraction of those that actually have claims being paid. That all being said, I think as this product has matured, buyers have understood how to make claims and how to monetize the policy, not in a bad way. I think when this first started out, everybody, no one really thought about, well, should I notice my rep and warranty insurer with this issue? Maybe I'll just work it out by myself. I think now everybody realizes that rep and warranty insurance pays claims. There's a sort of claims handling procedure in place. It's not like dealing with your auto or health insurance company. You have sophisticated claims handlers and nothing against auto or health insurance adjusters, but you have sophisticated claims handlers who understand the issues and are ready to help you reach a commercial resolution.
Mm-hmm. Great answer. Thank you. Next question here for Brian and Jenna. Do insurers rely upon buyers' due diligence, or do they do any due diligence themselves? Do insurers have access to buyers' due diligence reports?
So the way the process works, as Dan said, the insurer and the insured, the buyer, are really kind of on the ride together. And most of the insurers will hire a third-party law firm, such as Seyfarth Shaw or another law firm that has a specialized practice in representing the insurers. And the insurers rely primarily on what the buyer's due diligence is done. The insurer's process is not to replicate all of the buyer's due diligence. There's frankly not enough time or money to do that. We're taking the buy side due diligence that's already been done. And, I always say it's kind of doing due diligence on the due diligence. We're essentially, double checking the sort of conclusions they have. If there's a lot of outstanding issues, we're sort of following up on those, and, really trying to make use the due diligence that's sort of already there to help the insurers make their own judgment calls. There's, of course, times when, perhaps issues are particularly complex, or, the insurer's specialists think one thing and the buyer specialists think the other thing. And so the insurer's counsel has to really dive more deeply into issues, and it is a little more akin to their own due diligence. But, by and large, we're relying on what the buyer is telling us. And, there is sort of a good faith that what the buyer is saying, is truthful and honest. They're saying that to induce us to underwrite the policy. So, we're really relying on the buyer to do a very good job. And I'll say that too, we get a sixth sense on the calls. If the buyers have really done due diligence, that's good. And when they have, you're going to have a smoother process. When, we get on calls and we get a sixth sense that there's still a lot of holes and gaps, there's going to be a lot of follow-ups to it. So I think it really, it's to the buyer's advantage to take the process seriously, like Luke said. This is not it was music to our ears, Luke, to hear you say that you still do lots of thorough due diligence even with reps and warranty insurance on the policy. That's exactly what we want to hear, and that's how buyers should be looking at it. This policy does not, do away with having to do due diligence, because you're going to get on a call and have to answer a lot of questions. And if you don't have the answers, you're going to be back to square one, or have a policy that has a ton of exclusions, which isn't what we want either. It's not what anybody wants at the end of the day. There's no greater joy that Jen and I have when we call Dan up and say, this one's pretty clean. There's really nothing here. That's great. That's exactly the way the process should work. And, that's what we want to say at the end of the underwriting calls as well.
Awesome. Well, hey, we're up against the hour. Luke, Dan, Brian, Jenna, I really want to thank you guys for participating on this panel. For our audience, we will be sending out an email to everybody that's registered with Luke, Dan's, Brian's, and Jenna's contact information, and you'll be able to connect with them. Thanks again, everyone. Have an awesome day, and we'll see you again.
Thanks for having us. Thank you.